it's Henry Becker with Lighthouse Wealth Management, and in this quick video we're going to run through and get a deep dive on Morningstar's equity style boxes and kind of our take or how we use them internally to be informed about the market and themes within the markets. So let's flip over to picture-in-picture. And what we have is, this is a PDF file from Morningstar, the investment research company, and they pioneered these style boxes, which you see right here. And how they're broken down is basically takes the U.S. stock universe and breaks it down and by size of company, whether it's large, medium, or small. We'll get into the details of what that means. And whether it's value or growth oriented, or they call blend, but internally here at Lighthouse we say core. So what does value or growth mean? Let's talk about growth first. A growth oriented company a lot of times are going to be companies that they don't put their profits out as dividends. They take their profits, after everybody's paid and everything's paid in the company, if they have profits left over, they plow it back into the company. Prime examples of these in the not too distant past, Amazon, Google, Facebook, big tech companies tend to be growth oriented. A lot of healthcare companies too, when they're early on, whether it's biotech and those types of things. And so we can see down here in the corner, when they categorize something as growth, Morningstar that is, they look at forward-looking measures like earnings growth projections, and then historical things like what were the historical earnings growth, sales growth, cash flow growth, growth-oriented items that they're looking at in regard to each company. Then on the value side, they're looking at things, basically the price of the stock relative to whether it's earnings or the book value, sales of the company, cash flow. And the reason you look at price to those things is price to those things tells you how much you're paying for each one of those things, how much you're paying for each dollar of earnings, how much you're paying for each dollar in sales. The lower that ratio, the better for value orientation. So put otherwise, is if you could buy a stock that's worth $200 but you could only pay $100 for it, that's a good value. It's like anything else. If you can pay $10,000 for a $15,000 car, that's a good value. So that's kind of the difference between value and growth as it relates to investing styles. So now let's look at our take internally. So here at Lighthouse, when we go through some of our investment committee meetings, we break down, not like this, but similar to this, we break down each of the boxes and then look at what's happening. We try to gather themes out of what we're looking at. So the first thing to note is we have it set up the same way, Morningstar. We call it, like I said, we call it core versus blend. Large cap, these would be companies that are 10 billion or more in market cap. Mid cap between 2 and 10 billion. Small caps between 250 million and 2 billion. Now, what we have here are the returns in each of these categories. So what I've used is the exchange traded funds, or ETFs, for each one of these categories, right? So what we have in these boxes, these highlighted colored boxes, are the year-to-date returns for each one of these ETFs. So for example, the large cap growth ETF is up 25.64% year-to-date. And this is through the market close on October 15th, 2020. Now, in the core space, large cap core is the S&P 500. That's what we're looking at here. So let's look at the detail of that. So large cap core S&P is up 9.65%. The 5 biggest holdings we see, right? We see the weight of each in the index, meaning Apple makes up 6% of the index, where Alphabet, or Google, as you know it, makes up 1.6%. Now, the reason for that is all these index are what are called market cap weighting. I've done a video on this stuff in the past. If you're fuzzy on that, if you look back in our video history, you'll see there's a video on what the indexes are, how they constitute themselves. So with Apple at 6.81%, and Apple is up 66% year-to-date, right? That's what this is, year-to-date returns for each of these stocks. So you can do basic math and determine how much of Apple's return shows up in the large cap core index. So the one thing you also note is these companies are the same for core and growth, right? But the difference is the weighting. And the reason for that is in the large cap growth, index, there's less stocks, so there's a heavier weight on the companies that are in that index. So you can see much larger return because you have more exposure to these high-performing stocks. Now, if we move to the opposite corner in small cap value, one thing we note is much larger or much smaller percentage weighting in each of the stocks, right? Because A, there's more stocks in there, and B, the sizes of the companies just aren't that, it's just not that great. The delta, the difference between the market cap size of the smallest company and the largest company is not that great, where the delta in the S&P, the difference between the size of Apple and the size of the smallest company in there is very big. So that informs, how big a spread there's going to be between the weightings in the stocks. But if we come back to small cap value, we can see even though Green Dot has done very well performance-wise, it just makes up a small piece. The delta here between 25% and 16%, these two corners, we'll call it 40% delta, that's probably one of the biggest differences I've ever seen in the entirety of my career, 20 plus years. And there's a few things that are lending to why it's so wide. One is the obvious up here in the corner. These companies have done extremely well in pandemic environment for a multitude of reasons, of which I'm sure you could guess. Amazon, everybody's ordering from home. Apple with, multitude of things. Facebook, same thing. Google, same thing. YouTube and whatnot. The problem down here in small cap valueville is that going into the pandemic, this category was already lagging, and they were lagging because of what's inside the index. It's a lot of real estate, a lot of smaller finance companies, a lot of smaller healthcare companies, which have just not done that well in pandemic environment. So they went into it in a bad situation, and it just got exacerbated with the pandemic. So that's more or less the big reason between the difference between the two corners. Now, as you can see, if you invested, let's just say from an investment standpoint, you built a portfolio of U.S. stocks, and you put a third in large cap, a third in mid cap, and a third in small cap. Well, you can see these two would cancel each other out. You would have a negative return this year. You would not be where the S&P is at 9.65. You'd be negative. So a diversified portfolio this year is not really getting you where you want to go. Diversified portfolio of just U.S. stocks. You have to kind of shift or lean the portfolio around. So when we look at this every week, or I look at it every day, this kind of informs, it gives us an idea of, kind of like Tom, one of the other partners here, will talk about skating to where the puck's going, a hockey reference. And we kind of try to do that with portfolios is, where's the trajectory? Why is that the trajectory? And do we believe that's going to continue? Therefore, we want to lean portfolios. When we look at this, it also tells us that we want to make sure we diversify the strategies that we use. Like our competitive advantage portfolio, we have quite a bit of the large cap growth oriented stocks in there. Not only, but we have a good number of names that fall in that category. Our dividend grower portfolio, it's more in the value core orientation. And again, we're not trying to time markets with these, we're just having diverse strategies that we can use at any given time if we want to lean portfolios around to different places. Now, the last thing I'm going to touch on, the theme we take away from this is if we use Amazon and Facebook as an example, we're going to use them actually example in small cap space. When Amazon went public back 20 plus years ago, it went public and its market cap was roughly $250 million. So it was a small cap company. It showed up in small cap indexes, right? And it grew through there, through mid cap, and is now a mega cap company. Where Facebook and a lot of these newer tech companies, they stay in private hands for a very long time to the point where when they come public, they're large cap. That makes it very difficult for small cap fund managers. It makes it difficult for them to find those gems, small gems that are going to grow. A lot of these small cap companies nowadays, stay small cap. They don't grow like companies once did into becoming large cap companies. So that has made it very difficult for small cap space to garner the gains that they were able to get with companies like Google and Amazon back when they were little, or even Apple for that matter, many decades ago, came out as a very small company and has grown. So again, I hope this little tutorial on the style boxes, but how we use and look at and analyze the style boxes, has been helpful in understanding what's happening in the market right now. As always, if you have any questions, issues, or concerns, please feel reach out to me, reach out to anybody here on the team. Happy to help. Hope everybody's doing well out there, and keep your chin up in Corona time. Thanks.